And this is a 5 tick, meaning, well, again, if this is euro dollar, this is 5 pips. And you see how nicely this thing paints. If I was using a regular bar chart, or maybe a regular or standard candlestick chart, I would not see all these nice moves. I would have probably been whipsawed several times along the way over here. So again, similarly as on the previous one, right here we've got 4 opportunities to enter. We enter, we're going long, and again, 1/5 of the position. You'll appreciate this when the market goes against you or retraces a little bit here, a little bit there. Then you'll be able to improve your cost basis along the way. So again, we're going to summarize this. Step number 1, primary direction on a daily or 240-minute Heikin-Ashi chart. Step 2, trend. Slope of a 20-period moving average, either up or down on a Heikin-Ashi chart. You look at the price in relation to the actual line of the moving average. If it's above it, slope is up, the trend is up. If it is below, if the price is below the line, slope of the line is down, it's down. It cannot be any more complicated any more simple than that. That's pretty simple, right? Finally, trigger. Again, what you want to do is synchronize step 1, step 2, step 3. That's it. Now, when you can do that, and this is what my chart setup would look like if I were trading manually. If I were doing this manually, then this is how I'd be looking at my chart. This is my primary direction, up. This is my trend, obviously just turning right here, going up. And my entry would have been somewhere over here, right? That's the entry confirmed. When you use this simple setup, then you will be 75 to 80, you will have 75 to 80% trade entry accuracy. You will always make money when you pick the right direction. Now, exit rules. This is when you're trading manually. All right, when you're trading manually, there are very simple rules. Rule number 1, when in profit. Take profit when the range or Renko bar changes color. Simple as that. When you're in profit, the bar changes color, take it. Take the profit. Example, you entered here, bar changes color, you're out. Take the profit. You will wait for the next opportunity. Next opportunity, confirmed over here, you get in, you get out. Not a big profit, still a profit. Enter, take it. Enter, take it. Simple as that. The bar changes color. Now, bar changes color, you take profit. Trade exit rules when not in profit. Now, not in profit, there are 2 things. If the market is still if the market trend is still intact, then you can improve the cost basis, right? Improve your position by dollar cost averaging. And you can dollar cost average as many as 4 times. Remember when we, at the entry part of the system, only entered with 1/5 of the position that we would normally get in with? You've got 4/5 left over. And if the market doesn't necessarily go with you right there and then, as long as the same entry conditions are still in place or present, that is step number 1 and step number 2, you can enter as many as 4 more times. And that will improve your cost basis. And then, when you're in profit, the bar changes color. Guess what? Rule number 1. When in profit, range or Renko bar changes color, take profit. So after you've improved your position, provided that the entry conditions are still present, when the bar changes color, you take profit on the entire position and repeat the process. Now, so far, you're still making money, right? Now, for example, you entered here. You thought this was a good entry. But the market just kind of doesn't want to cooperate. I mean, eventually it will be going up, but you don't know this. You don't see. You don't have a crystal ball. You don't know what is going to happen. So you just kind of watch the market, see what happens, see what happens. And now, over here, you've got an opportunity to enter back in, provided that step number 1, that is the primary direction and trend, are still to the upside. You enter at this point, and the difference between this price where you entered and this price is basically has to be at least, the difference between the prices has to be at least the difference of a trade recovery interval. A trade recovery interval is simply one daily average range of a market divided by 5. So if the market, say euro-dollar, if euro-dollar has an average daily range of 100 pips, then your minimum trade recovery interval would be 100 divided by 5, which is very good.
How are you measuring range?
Range, I will look at the last 14 days. I will look at average true range, ATR, of the last 14 daily bars. That's just basic stuff, right? So I will look at that divided by 5. Why 5? I like 5 because I divide my position by 5. I have 5/5 of my position to enter at different points. Now, there's also another reason why I use 5. Because the way I dollar cost average, and I do this with software, I enter at different points. I take my entries from different charts. Take it from a 5-minute, then from a 15-minute, then from a 30-minute, then from a 60-minute, and from a 240-minute. When you add them up, that's 5 different ones. 5, 15, 30, 60, 240, right? So on every one of those, if the market's going with me, on every one of those, I use my 1/5. So by the time I get in, I improve my cost basis, and it just makes so much more sense, right? So here we are, trade recovery interval, and right there you've got the trade recovery interval in place. Rule number 1, original trend is still intact. Rule number 2, minimum trade recovery interval. Difference or spacing between 2 trades is minimum 1/5 of average daily range, and you've got maximum 4 additional trades after the first one, right? That's the 5/5. So trade exit rules: if not in profit and original entry conditions are no longer intact, apply hedging, and when Heikin-Ashi bar changes color on the trend chart. Now, or this is a highly sophisticated, the most secret ever way of trading. And it's called, I call it zone recovery. It was my team at Global Profit Technologies invented this, and it is by far the most revolutionary way of trading. It will not allow you even to take a loss. The way I develop the strategy is that I look at not just these 3 charts, I look at probably about 8 charts at the same time. For me, how difficult is it to do for me? Well, not as difficult now as when I first started getting the ideas how I should be trading, obviously. But it's not really that hard. You just have to be disciplined, and you can't be trying to rationalize and contemplate and procrastinate, none of that stuff. You have to pretty much, women are better at this than men, by the way, because they don't think as much as men, men do. And that's meant in a good way, because men, and the reason why I'm saying this, because I have friends that are traders, and they talk themselves out of a trade, and they try to beat the system, always improve, thinking that they're better than the system itself. And then what ends up happening is that they deviate from the system, then they get themselves in positions that they didn't really want to be in the first place, and it's just they create chaos for themselves. But when I trade manually, I look at the 5-minute as well as the 15, 30, 60, and 240, and I take my trades not off of just one. I take 5 entries at the same time as opposed to just one. That's me, though. Zone recovery. And it's basically a very simple mathematical algorithm. What is an algorithm? Algorithm is a mathematical formula. That's all it is. And it's a simple one at that. You know why? Because the markets are not complicated. They only can go up or down. That's it. There is no third direction, like into the wall or into the screen or somehow 3D. It's a 2D, up or down. If they're flat, they're flat. There's nothing you can do. But really what you're concerned about is the 2 directions. Right? Now, this is manual hedging. If you're trading manually, this is a good way to escape or to improve your cost basis or improve your position when the market goes against you, right? Zone recovery is an advanced hedging. It's a step above this. I would say probably 2 steps. But let's look at the hedging. If you enter, and I think somebody asked over here, no, this lady, was it? No, or that lady right there. You said this is where you exit the position. And I answered, I don't exit the position. Instead of exiting, I hedge. In other words, definition of hedging is taking an opposite trade, exact opposite trade. And I do hedging, or I hedge when the market goes against me. In other words, when the trend, that's step 2, when the trend changes. And I'm still in a position that has not made me any profit yet. So what would I do? All right. This is my original trade. Obviously, I got in at the wrong time, at the top of the move. Market turns. What do I do? Oops. All right. And we're looking at this is a you see this? This is a 60-minute chart. So this is my trend chart. When this happens on the trend chart, guess what? I enter into this was a long position based on the original trend. Now I enter into a short position. Here's my hedge. Market goes down. I will exit the hedge when the trend resumes in the original direction or returns to the original direction. And that happens right here, and it's actually confirmed on the MACD right here. So my original trade is still open. I did not exit it. all I did is in the meantime, I entered my hedge and I took the profit from here to there. Now, I'll take this back. By entering this position, which is a short position, I pretty much, as far as the broker is concerned, pretty much evened out my position because I have my long and my short, and that makes me flat. This could be my whole 5/5 right there because it's the 60-minute chart. It's the whole trend that changed. I might have been all already in. That is not important. What is important that when the market turned on my trend chart, I go into an opposite position. So in other words, I open a short. The broker sees me flat. As the market goes down and I close the short or exit the hedge with profit, automatically that original long reopens up. Correct? Can you see that? Basic math. This position was never closed. The original trade is still there. And as the market is turning, now that I'm in profit, I take my aggregate profit and I'm out. Now, if trend doesn't return, if this thing never was to happen, guess what? When the trend reverses, I'm adding onto the short position. In other words, I'm reversing positions. Next. Now, remember, and this is kind of important, no matter how good your trade entry is, the market will sooner or later go against you. Who would agree with that? All right? It will be your ability to handle these situations during reversing markets that will determine how good of a trader you're going to be and how successful, how profitable you're going to be. Most people just sit there and sweat as their trade is eroding their account. You've been there, done that, right? Right? All right. Zone recovery trading algorithm. Here we are. It's a defensive hedging strategy. You don't use zone recovery to make money. You use the entry, the simple trade setup, the entry setup to make money. That's what makes you money. But zone recovery is defense when everything and the kitchen sink go against you. That's how you get out of a bad trade. It's a defensive hedging strategy. In other words, opening a trade in the opposite direction of the original trade based on a mathematical formula, also called algo or algorithm, algo trading. You've heard that, right? Who uses that? Who else? The guys with money, because they know they're not as smart, as fast as a computer can be, right? Which eliminates trading losses altogether every time, 100% of the time, when set up properly. Now, what it does, it literally turns every losing trade into a profitable trading sequence. In worst case, break even. Unless, of course, the markets completely stop moving. Now, if the markets were to stop moving and they say, okay, this is it, we have no more trading, everybody go home, then we've got nothing to talk about, right? All right. This is, ladies and gentlemen, this is a big deal. This is life-changing. It is earth-shattering. It sets up, in my mind, in my opinion, a completely new way of trading, a new paradigm in trading as we know it. And I'm the one to bring it to you. All right, so here we are. let's assume this is our trade setup. Price is here. That's the current price. Now, where do you think the market's going to go based on this? We don't know, and for this illustration, we don't really care. That's not important. If you do your setups right, you will be right 75% of the time. Now we're only going to talk about the rest of the time. Now, we could say that the market is going to go up. This could be a long trade setup, right? Now, if we're right, this is going to be our target. Now, the market, though, could be going this way, could be going down. See, we don't, from this point forward, from here, we don't know yet. See, what really blows me is when, you know, I listen to these teachers that probably have never traded in their lifetime, and they're showing a chart, and, oh, this is, you go in here, this is where you take the profit, you go in there, this is where you take the profit, but they don't trade. They only do this with the benefit of hindsight. Now, we don't have hindsight when we trade. We have a blank canvas. We don't know what's going to happen. The market can go up. We have a target. We want to make money. Or the market can go down. Then we'd have this target. Right? Now, you will become an excellent trader when you make money as long as any one of these targets get hit. Now, and I will argue with you that no matter what this price is, sooner or later, I don't know when, and I don't know which one will come first, but I know in time the price will be either here or either there. Right? The market will either go up or go down. That is one thing I know for certainty. I may not know when it will hit down here or up here. And I may not know which one will hit first. I also know this. It will not happen at the same time. It will be one or the other. Now, and I present to you that I will make money as long as one of those targets get hit, regardless of which one it is first. Doesn't matter. Right? Here's how it's going to happen. Here's the price. And we're trading euro-dollar now, 2.950. This is from a couple of days ago. Now, let's assume that our setup is to the upside. Right? So we're going to place a long trade, one lot. Let's assume we're trading 5 lots, so this is our initial 1/5, right? And this is going to be our target, long target, 150 pips. We're going to try to hit 131. Well, we're going to try to. We're hoping to. We're not going to affect the market, but now, if we are right, obviously, we're going to hit the target. But let's assume we might be partially right, or we might be completely wrong, but we don't hit that target yet. The market goes the other direction. Well, if the market goes the other direction, it will go down. We have a long trade. What do we do now? Well, we will get to a point where we're X number of pips, and let's just call it, for the sake of illustration, when we're 50 pips underwater, or 50 pips in a loss on this particular trade, we will enter a short trade, a hedging trade, hedge trade, right? And with that trade, we're going to target profit on this trade, a short trade, 150 pips. And that price would be 127.50. Now, in order for us to do that, with this trade still open, we'd have to place a trade of 1.4 lots. Now, the key is, worst case, to break even. So stay with me here. I am one lot long at 125.50. If I happen to hit this target, I will be 200 pips short. I will be losing 200 pips on this one lot, correct? So I will be 200 pips down from 129.50 down to 127.50, correct? True or false? True. But at the same time, on 1.4 lots, I will be up 150 pips. So you do the math for me. How much will I be up here? Anybody? 1.4 times 150? 210. So aggregate, I'll be what? 10 pips up. I'll close my entire sequence, which started off with a long trade. I'll close the sequence on my recovery target with a 10 pip profit, even though the market went against me. Now, easier said than done, right? Well, suppose the market reverses, goes back up again, doesn't hit my target. Well, not what I really want to have happen, but guess what? Right on the same, at the same entry point as I placed my initial one lot long trade, I'll place another long trade. And this time it will be another lot. So right at this point, I will have 1 + 1, 2 lots going up, and 1 point. By the way, these are all open trades. I don't close any trades unless the whole sequence is in profit. That's what we established, right? So I got 1 + 1 is 2 going up. If I hit this target, then I will have 2 lots in profit, 150 pips, which is what? Plus 300. Now I will have 1.4 lots, 200 pips down, which is what? Minus 280. So on my long recovery target, I'll close the entire position with a 20 pip profit. Now, if I hit it, if I hit here, guess what? I made profit. If I hit here, I made profit. Suppose, and basically what I have established, I have established my zone recovery area, which is the difference of my acceptable loss on the first original trade. What's my acceptable loss if the market goes against me? 100 pips, 200 pips, 50 pips. In this, for the sake of illustration, we made this 50, right? So that's my zone recovery area. And the way the zone recovery algorithm works is that it places long trades on the upper boundary and short trades on the lower or bottom boundary. So that if I don't hit this target and the market reverses and heads back, then I will place another trade down here at 1.4 lots. Now do the math with me. I have 2 lots. If I hit this area, if I hit this target, 2 lots, each of them 200 pips down. That's minus what? Minus 400. but I have 1.4 plus 1.4, that's 2.8. In profit, 150 times 2.8 is what? 420? Right? So if I hit this area or hit this target, I what? I made 20 pips. Right? See, I don't know when or which one I'm going to hit first, but I'll tell you this. Sooner or later, I'll hit one. If I don't hit it this time, the market turns. Place a trade of 1.9. You add them up and you'll find out when you hit this area or when you hit this target, you'll be making money again. If it reverses, that will be 2.5 lots. You hit this target, you make money. So basically, it doesn't matter which direction the market is going, and doesn't matter which direction your original trade is. Sooner or later, it will hit a price above or below your entry. And when it does, you will clear the profit from the entire trading sequence. That way, you never have to take a loss. You don't have a stop loss. Zone recovery, in my opinion, is such an awesome strategy that you can even trade against the trend and still make money. Now, I don't recommend it, but if you can do it, how much better does it get? See, I don't sweat and try to figure out which direction the market is going to go anymore. It doesn't matter. I make money every time. Every time. Every time the sequence of trades closes, worst case, I've broken even. Everything else is profit. Now that's pretty good math, if you ask me, right? So when using zone recovery in the proper way, I'll show you, it is virtually impossible to lose money regardless of your order or market direction. So if you really think about this, everything you have learned up until this point, up until now, you can throw out the window because it won't matter anymore. It doesn't matter. We change it. There's a new paradigm. Now, let's look at it again. Current price. Let's assume the market's going up. We enter long, right here, the current price. If we're right, we make money here. That will happen 3 out of 4 times when you properly do your entry setups. If we're wrong, market reverses. If the market reverses, we enter short at the bottom of the zone recovery. If we're wrong, we make money here. All right. Now, same thing. If we think market's going down, if we're right, we make money down here. If we're wrong, market's going up. We enter long here at the top of the zone recovery. Basically, the zone recovery is this set number of pips that your original trade goes in the red. That's it. Here's how your trading results should be. 3 out of 4 trades, you take profit because that's just good setup. 1 out of 4, Worst case, break even. Now that to me is pretty good results. Right? So now how do you do these zone recoveries? Well, obviously this is easier said than